Maybe you've seen it before, but traders, they're just like the leeches of the market. They're unhealthy. They don't contribute anything to the market. Is that really true? For those of you that watch, my videos just as a whole, I've covered this topic a few different times before from different angles, and I want to cover it from this one. But the point being, oh, you traders, you contribute nothing to society. You take advantage of other people. You just sit there, click buttons. You offer no value to a company because you don't invest. You hold their stock for a few minutes, maybe a few days. Maybe if somebody's lucky, you'll hold on to their stock for a few weeks. But traders as a whole, contributing absolutely nothing. And this also, applies to the whole algorithm things. All you high frequency trading, all you do is, take advantage of the system by writing your computer programs, blah, blah, blah. Point here being the whole trading thing doesn't, contribute anything to the healthy well-being of the market. And is that actually true? And the reason is, no, that's just false. That's irrational. It's a illogical, argument statement that you could see in the headlines that some people have their thought process of. And I'm going to map out exactly why that's the case. And it all revolves around the word liquidity, meaning your ability to take your stock and convert that into cash. And ideally, take your stock, convert that to cash at good prices, very fair prices compared to, some other things, in the world that may be not so liquid. But for this, let's just say, and we'll go through an example here, that we have, I don't know, what's the name? I always use Billy Bob. Let's just go with Ed. So we have Ed, and Ed is 75 years old. He's been an investor for like 40 years, long, long time. So he is obviously in retirement, and he has some stock, and let's say he's got some Apple. And he's got Apple stock, and now he wants to sell it. And let's just take an example where there are no traders in the market. It's just long-term investors like Ed. So he's going to go, so this will be the world of just a bunch of Eds out there, long-term investors. Yeah, there's lots of long-term investors, but when Ed wants to sell, these are going to be his opportunities to sell. And yeah, there's opportunities out there to sell his shares of Apple, but there's not going to be that many market participants that are going to say, Ed, yeah, I'll buy your Apple. Because remember, in order for, Ed to sell, there has to be somebody willing to buy. And I'm sure one of these people say, yeah, I'll buy. But there's not a whole lot of necessarily competition out there, right? I mean, there's some people, but there's not a whole lot of people. Why is there not a whole lot of people? Because in this case, this is just the ideal world of, well, there are no traders. There are no computer algorithms. There are just simply investors out there. And as far as competition is concerned, there's just not much competition. And when there's not that much competition, it's going to be hard for Ed to get a good, solid price when he wants to sell his Apple, which, hey, he's held for a long time. He deserves to get a good, fair price. Not something where it's like, oh, wow, that's all I could do? But let's go and flip things to the other side. The world of traders, the world of algorithms, the world of supercomputers, the world of high-frequency trading, whatever you want to talk about it. Day traders, swing traders, any of those traders, algorithms that maybe you've heard, they're so evil. They're taking advantage of. So now we have investors out there. So let's get our investors. There are 6 of them. But now we have all these other components. So let's just say that we have, the human day traders. Let's just say that we have the human swing traders. What is that for? And then, of course, we have all those algorithms. Then we have the algorithms. And then, we have something else that will probably eventually come along, another form of trader. So we'll just, another form of trader. So What does this competition over here look like? I'm assuming I installed in your intelligence thinking, well, holy smokes, there's a lot more participants in this market. And the more participants that are out there, that's best for Ed when he wants to sell his Apple shares, because instead of having 6 people that might want to buy, and yeah, Ed, I'll buy, but only now you have all these different types of people, investors, day traders, algorithms, et cetera, that are ready. So the more people, the more liquidity that's available in the market, and more liquidity means better prices for Ed when he wants to sell those shares that he's held onto for 30, 40 years, whatever it may be. So to sit here and have the mindset, or for these people to make comments of, oh, the algorithms are bad. And I don't use algorithms. I'm not like a high frequency trader with computer programs. So I have nothing, no vested interest to make the case. I am a day trader. I'm a trader. I also invest for retirement. But it just doesn't make sense from a very basic scenario, which in my mind, hopefully I've outlined this. But when I want to sell something, the more people, the better. Maybe you've tried to sell a car. Maybe you've tried to sell a house. Would you rather have 6 people? Well, I mean, in the world of cars and houses, that would still be a lot. But 6 people knocking on your door, hey, I want to buy your car. Hey, I want to buy your house. Or would you want this many people knocking on your door? What situation do you think is going to get a better price? I mean, this one is going to have a massive bidding war to get your car, to get your house, compared to this. So the more people, the better. Hopefully I'm stating the obvious when I say that, but that's why it's just laughable when people sit here and say that, oh, you traders are evil. In the world of penny stocks, it's always, oh, the flippers are evil. No, the flippers are adding to liquidity. They're giving people a better chance to sell their shares for better prices. So don't fall into that trap of thinking that traders are bad, traders are taking advantage of the system. No, traders are providing the system with more opportunity. They're causing prices to go up. They're helping investors get the best price when it's time for them to sell their shares. So keep that in mind. Remember kind of the dots. Hopefully the dots can kind of illustrate just how traders and such do contribute to the market. Sure, they don't contribute to a company necessarily in the sense of, they're investing in the stock for the next 40 years, but they are helping out in the long run in terms of when Ed over here wants to sell those shares. So keep that in mind and don't fall into that trap of trading, algorithms, all that sort of stuff not contributing to the market.